Hello, welcome to my quarterly update for the Ftse 250, and also I'll be taking a look at some macro data. Before I start, please remember that I do these videos just for fun as a hobby. I'm in no way an expert and always speak to a qualified financial advisor before making any investment decisions. So first of all, why am I looking at the Ftse 250 and not the Ftse 100? Well, the reason is that the FTSE 100 is far too much of a idiosyncratic index. The top 10 stocks account for nearly 47% of the entire market cap of the entire index. And as you can see, these tend to be very defensive things. And they're all huge conglomerates with lots of international earnings, not really UK based earnings. And so this renders the FTSE 100 as rather a tone deaf indices that isn't really that useful for you as a benchmark for how things are with your typical stock you might be invested in the UK. So that's why I'm going to be focusing on the FTSE 250. And I like to go back first of all to a long time frame. And first of all, we see that over time the value of stocks goes up as a trend. And that does make sense because over time GDP does tend to grow, typically by a couple of percent a year. And then on top of that, you've also got the impact of inflation. So this trend does make sense. And what's interesting is that there's a definite gradient here, but then after the credit crisis of about 2009, that gradient then steepens. And also before the credit crisis, we used to get these classic bubbles and then collapse, these traditional market cycles. But then ever since 2009, it just seemed to be more of a case of just following the trend line. However, then when we had the Corona crisis, that did then elicit quite a fall down here. And then what's interesting is that after we recovered, the moment we started to see inflation and then therefore the risk of interest rate rises, that's when we then saw the FTSE 250 drop. The same, by the way, with the S&P 500. And then the moment everyone started talking about a pivot, there we see it go up again. So that's quite an interesting trend. But in the long term, there's definitely a trend that the general behavior changes before and after the credit crisis, and also the steepness of the gradient changes. So you can see that here even more simplified. And of course, what happened was when we had the credit crisis, the central banks started to use a new strategy where they'd have near zero interest rates, and they started embarking on huge amounts of quantitative easing, otherwise known as money printing. But it has to be said that this was in fact fairly successful in keeping GDP elevated and also stocks with it. And we have had fairly low inflation as well throughout this period, and low unemployment. So I did some research into what is the style of economics which the Western governments currently follow, and the best I could get was New Keynesian economics. This best explains their behaviour, where they use very low, near zero interest rates and lots of but then also combine that with excessive money printing, as well as all kinds of government fiscal deficit, to enable to achieve hitting their target of 2% inflation, 2% GDP growth, and low unemployment. And actually, there are a set of mathematical models which are called the dynamic stochastic general equilibrium models. And these directly feed into New Keynesian economics. And the central bankers, when they have their FOMC meetings and things, they actually have spreadsheets with the dynamic stochastic general equilibrium equations on those spreadsheets. And they really do believe that they have total control on the world economy. And perhaps they are PhD geniuses, as this would suggest in the last 10 years, perhaps. However, there is also the point that in the last few decades, we've had these extremely deflationary forces, particularly globalization and the growth of the internet. And in a way, these have countered the inflationary forces of all this money printing, which perhaps allowed the governments to get away with this new Keynesian economics without inflation getting out of hand. So, although obviously the UK is nowhere near as advantaged as the US, still 5% of the world global currency reserves are in pound sterling. And so this to some extent allows our central bank to get away with the money printing in a way that a lot of other countries wouldn't be able to. Although this NKE game plan is definitely a thing, it's only able to happen because it's enabled by these factors, particularly the deflationary forces that have been inherent and the fact that we've got a artificially strong pound sterling versus other world currencies. Now, here's the data that I collate, various different macro data points, but the most important ones really are interest rates, which seem to be baby stepping up. And I summarize the most important ones on this dashboard here. And so, first of all, inflation. Now, the target is 2%, and I work out that we currently have 4.8% inflation. Now, I do this because I'm using CPI month on month to work that out, and I don't find the year on year data very useful. But when I look at month on month, I bundle this into quarters, and so based on the first quarter of this year, that's equivalent to about 4.8% year over a yearly basis. So we see that whereas last year we really were in extreme crisis mode, the inflation problem is a lot less bad now, but it's still fairly high at 4.8% per year. I somehow think that this highish inflation suits the government in some respects because it helps it inflate away its debt over a long term. But it's still definitely too high at 4.8%. But at least the trend is a gradually improving one. And then looking at GDP growth, so I've only got 2 data points for this year, but then that would work out at 1.6% for the year. We certainly haven't got a problem with unemployment, so that's positive for the overall picture. And actually, house prices seem to be holding up at the moment as well. So the general picture here is one of stagflation. And here I've plotted inflation against real GDP. And it's quite clear that actually, for over a year now, the UK has been in a situation of stagflation. And then that's backed up even more when we look at retail sales, where the volume of goods is diminishing now for over a year, whereas the cost of buying those less number of goods is increasing. So that's classic inflation and classic stagflation when you take into account the volume as well. So I myself really do believe that we are in entrenched stagflation, and I sense that actually that will continue for quite some time. Now, in terms of the general environment, how balanced is it? Well, the energy crisis seems to be dropping away lately, and so that seems to have helped us. There have been some bank bailouts, but actually, probably only one burner blast is probably more appropriate there. Generally, this is more imbalanced than it was last year. Last year, this was all boosters firing. Now we're in a lot less problematic of a situation. So obviously there are general risks now on a lot of news outlets and other YouTube channels. Actually, all you ever hear people talk about week in week out are the different risks. So it could be China, it could be computer chips, it could be Taiwan, it could be, more recently it's been the banking crisis. But it's actually more of those kind of headlines and less of the actual data and less actual proper accountable predictions of what's going to happen. That's obviously a lot harder to do. Obviously, you follow various news sources to get updates of all these risks, but generally, the situation at the moment for me is it's probably more balanced than it was last year. I think in terms of globalization, the main risk there would have been if China had have sided with Russia and started supplying them with loads of weapons, but that doesn't seem to have happened. I think in the future, AI, particularly Chat GPT, this is going to be a very deflationary force, but I don't think we'll feel the effects of that for some time in the future. But when it does kick in, that could then allow the government to do all kinds of QE, even to MMT proportions. That's probably quite a long time off. Really, the problems here have eased, if anything. I think maybe the deflationary forces have faded a bit, but not yet in a calamitous way. And on this side of the equation, the I would say the biggest issues would be the energy crisis or some kind of massive banking crisis. There is obviously talk of food inflation, but I guess despite all the noise, certainly compared with where we were last year, this is now looking a lot less inflationary. So the bottom line is, I'm not really troubled by the deflation inflation balance at the moment, but there are key risks there that you have to factor in when you decide about your portfolio selections. And then the other thing is this new Keynesian economics behavior is also enabled by having this artificially strong pound sterling, which is partly because it's used as reserve currency, but also the position of the UK politically, historically, and how that gives people confidence in it, where it is allowed to issue debt at cheaper rates than other countries. Part of that is our government debt and fiscal deficit, which although these numbers look horrific in their nominal value at 2.5 trillion government debt and fiscal deficit of 0.2 trillion a year, when you compare as a percentage of GDP, those fiscal deficit numbers are actually not that bad when you compare with before the COVID situation. And here I've got GDP against government debt, and you see the government's decisions over the COVID pandemic made us 10% poorer as a government, made us 20% poorer and more indebted as a government. But the situation does sort of seem stable. The way I test this big enabler of NQE, which is the artificially strong pound sterling, I like to do that by comparing the pound sterling against the Swiss franc. And you see that although it dropped in value by 10% last year, it has kind of stabilized. So we're 10% poorer again, but it has kind of stabilized. When you look at the yield curve, though, this is what a yield curve is supposed to look like. But this is what the UK government bond yield curve looks like at the moment. And as you can see, we now have a inverted yield curve. It was actually only flat 6 months ago. The orange line is 6 months ago. The blue line is now, and this is a worsening trend. So it's more. It's looking more dangerous now than it was 6 months ago. And we have a implied probability of default of 0.33%. So am I saying that the pound sterling is going to collapse tomorrow? No, I'm definitely not. It's a unlikely event. We see here the implied probability of default is only 0.33%, but it's still indicative of a problem. A lot of people have indicated that this inverted yield curve means we're about to go into a recession based on historical data. It could also be a sign of the currency about to be debasing big time. What I look at it is that it means that there is an enhanced currency risk that I have to factor into my calculations. Another thing that springs to mind is that with the yield curve under such duress, presumably that will make it difficult for the government to drop interest rates like so many people are saying it's going to. And that does play into my pet theory that we could actually have a extended period of stagflation if the government isn't able to drop interest rates because the pound sterling is under such duress. what I see as in a stagflation situation, but things are generally kind of improving. But at the same time, you've got these severe risk factors that you need to factor in. So zooming in now to the last 5 years, and it really is interesting looking at the FTSE 250. Now, first of all, bear in mind of the actual composition of the FTSE 250. And we see that in contrast to the FTSE 100, which is just mainly huge defensive stocks, with the FTSE 250, we have quite a broad spectrum of different kinds of companies and a lot of kind of main street companies, a lot of things which won't do well in a kind of stagflationary situation. Also, remember that 50% of the FTSE 250 revenues are within the UK. And what's really interesting is that 34% of all the FTSE 250 is investment funds, in contrast to the FTSE 100, where only 3% of the FTSE 100 is investment funds. So these investment funds are essentially the pension funds and the money that just really rich people have, they put into investment funds. And this is a lot of that is the baby boomer generation. There's a lot of cash there just sort of sitting there, but I think these investment funds, they act as a kind of dumb catalyst. So because they just invest that money into the other stocks, then as the stock market goes up or down generally, they kind of accelerate that. But a very interesting observation is that the FTSE 250 and also, roughly speaking, the S&P 500 as well, by the way, these have high proportions of investment funds. And isn't it interesting that for the FTSE 250, it started to crash around September 21. And interestingly, this was when we started to see the inflation, which then only got worse, and then we saw the interest rate rises. So it's as if the very threat of interest rate rises led to this decline in the FTSE 250 and also the S&P 500. And then, interestingly, we start to rebound back up the moment everyone starts talking about the Fed pivot, and then also for us the Bank of England pivot. So I do find that very interesting that that a third of the FTSE 250 is investment funds, and then also its behaviour seems so pinned onto interest rates. So the big question is what now? Now, there is, of course, the Goldilocks theory that says that inflation is going to go away and the central banks are going to be able to pivot, and then they're going to pivot really hard, and then we're back to normal. Now, I don't really quite see that as happening because I think inflation is still too high at the moment. My judgment really is that we're going to see interest rates stay quite high for quite a while, as long as the inflation is well above the 2% target. And I kind of expect a slow decline. This is the Office for Budget Responsibility's predictions for for how inflation would be, versus here in the black crosses I've been plotting, well, it actually has been. And as you can see, in the original plan, there was a very gentle slope. I kind of perceive there to be a very gentle slope. So myself, I'm expecting that they'll actually keep interest rates at around a similar level for quite some time, because I'm just not confident that inflation is going to go down quick enough for them to achieve this Goldilocks theory. Now, I myself am favouring a stagflation trend, and the problem is I just have no idea how that looks in terms of the chart flow. But a lot of people are calling for a massive downfall. A lot of people are calling for a big downfall from here. And myself, I kind of think that's less likely, but high risk. But elevated risk when we look at some of the other things like yield curves. So myself, I'm planning for a kind of more longer term stagflation trend, but I'm also factoring in elevated risks of something really going wrong, like a banking crisis or something. So now to turn to the FTSE 100, because this is what most people are obsessed by, even though I've determined that it isn't really so useful as an index. So half of the FTSE is just these 10 stocks, which really dominate its behavior, and they're mostly defensive stuff. You know, we've got liquor, people want to get drunk even in a recession. Tobacco, people smoke even more in a recession. Hydrocarbons and commodities, in a recession, they won't do well. In a stagflationary situation, I'm wondering perhaps they might do well because we've got the inflation aspect. Consumer staples, I think, do well in a stagflationary situation, and also pharmaceuticals as well. People are still sick. People are still sick even in a recession, and even when there's inflation. So the FTSE 100, interestingly, I think in a long-term stagflationary situation, should actually keep along its long-term trend line. I've got here the FTSE 100, and actually it really is fascinating that the FTSE 250 has this changing gradient following the new Keynesian economics policies, whereas the FTSE 100 does not have any change in gradient. And also the difference between the two is the FTSE 250 is loaded with investment funds. But anyway, back to the FTSE 100, and I really can see it in a stagflationary, given the nature of the stocks that it's composed of, actually just carrying on regardless. However, if we have these big doom and gloom predictions come right, that that the majority of commentators are saying is how it's going to go, then obviously you would get a bit of a correction there. So I do my quarterly overview of the macro situation and look at the charts, and from that I decide what percentage of my portfolio I want to be in risky stuff like equities. My target stance is currently 30%. We see here we've got the if we had the Goldilocks option, I'd have 80% in stonks. If we had the stagflation scenario, which really is my favorite, 50%, recession scenario, you've got the big crash coming, then 20%. Now, I've decided that although I'm fairly sure we're kind of a year into a longer term stagflation scenario, that really is my pet theory. I'm going to still stay defensive at just 30%, but I'm going to wait to see the data. And if over the next few quarters I see the data gradually improving, then I am going to start increasing my risk up to about 50%. So that completes my macro analysis and update for the FTSE 250. I don't pretend to be an expert at all. I consider myself an amateur at this, but you have to have some kind of base case and some kind of plan. And that's the most important thing about managing a portfolio, just to try and stop oneself constantly buying and selling stuff in response to the latest news story. I'm in no way saying that my analysis here is correct. So that completes my look at the FTSE 250 and macro updates. Hope you found this video useful, and see you next time. Please read the disclaimer. Remember that prices can go down as well as up.